So let's understand what intercorporate really means. Intercorporate means that one company is investing money into other company. So intercorporate. One, for example, let's say Larsen and Toubro buying shares of Infosys. Okay, so this is an intercorporate investment. These category of investment we would broadly classify into three major categories. So the first category of investment would be investment in financial assets. The second broad category of investment would be investment, or would be called as investment in associates. And the third category of investment would be investment in subsidiaries. So it works like this. Let's say that you are a listed company and you have a treasury section or treasury department where excess cash that your company generates for short term, that has been taken care of or invested into appropriate funds. So the treasury manager or finance manager of your company buys shares of some other listed company. So let's say buy shares of some XYZ amount, which amounts to 0.001% of other listed company. So here our intention is not to get involved into that business. So when we are buying shares, we are purely looking at those shares as some sort of a investment into financial assets. So this is your first category. So when you are buying shares into other company, and typically your stake in other companies is less than 20%. Okay, so you've bought 1% of other company or 2% of other company or 5%. Then we will classify that type of investment into financial assets category. So roughly I will say stake is less than 20%. Now imagine that Larsen and Toubro started buying shares of some IT listed company. So Larsen and Toubro being an engineering company, it started buying shares of some listed IT company. So it kept on buying shares and it has got now about total 17% stake into other company. So we will roughly classify this into financial assets, where we will say our intention is to not to delve into that business, but we've just parked our excess money. But we keep on buying more and more shares, and now let's say that we have a stake of about 29%. Now with 29% stake, L&T will have a substantial power to influence the decisions of that subsidiary or that associate company. So then you would reach here. So typically in this section, you will have a stake which is more than 20%, but typically less than 50%. So you have a significant say in the company, but you do not control the company, and therefore this is being called as investment in associates. And now L&T keeps on increasing its share into that IT company in such a way that now it has got, let's say, 60% share. And once I have more than 50% share of any listed company, then I have a controlling interest. Then I can decide what employees to recruit, what kind of actions are to be taken. So in that case, it would be called as investment in subsidiaries. So typically we will reach here when your stake is more than 50%. So less than 20%, 20 to 50%, and 50% and above. Now the true test to determine is that one company should be able to exercise significant influence on the other company. Okay, so 20 to 50% is just an indicative number, saying that if your stake is above 20 and less than 50, generally the firms will have significant influence. But the true test that we use to measure is that whether a company is really being able to influence the other company. So let's assume a scenario where your stake is only 18%, but you still have ability to exert significant influence. You will still be in this category. Is that clear? And the last one here, the true test to check whether it's falling into this category, is that whether one company is being able to control other company. Okay, so again, more than 50% is an indicative number, but the true test is control and true test is significant influence. Now the first part of this flow chart, this we had studied at level 1, that this financial asset is broadly classified into 3 major categories. The first category here, this would be called HTM. What is HTM? Held to maturity. And what you would remember with HTM is we do not have equity shares into this segment, right? Because equity shares do not have maturities. Then the second category that we will have, available for sale, and the third one is trading or yes, designated at fair value. Okay, so more or less similar category, though some small differences that we will get to study in depth now. So 3 broad categories: held to maturity, available for sale, and designated at fair value. Okay, so roughly this is the reading that we have to go through. The first part of the reading would be focused on how do you do accounting for this, which is repetition of level 1. The second part would be focused on how do you account in case of this scenario where the method that we use is called equity method of accounting. So in fact I can write it here. That method that we would be using is equity method of accounting. And the fourth part, where we have control, the method that we would be using here would be called consolidation. So let's start in the same sequence. I'm assuming that you've written this. So these are the major categories. In fact, there is one more. So financial asset less than 20%, investment in associates 20 to 50%, but the true test is significant influence. Investment in business combination greater than 50%, and here the true test is control. And then joint venture, okay, which in most of the examples would be given as 50-50% stake. Now financial assets, again we further divide into 3 categories: held to maturity, available for sale, and marketable security. So let's try to recall how we accounted for them at level 1. This is HTM, this is AFS, and this is trading securities. On balance sheet, HTM was shown at amortized cost. On balance sheet, AFS were shown at fair value, and trading securities were shown at fair value. So amortized cost, fair value, fair value. On income statement, in HTM, we used to show realized gain. Realized gain were made of 2 parts. One was coupon received. Second one, amortization of discount, if any. Amortization of discount, if any. In AFS category, on income statement, we show only realized gains. And in trading, on income statement, we have to show realized gains plus unrealized gains both. Then in other comprehensive income, OCI, in HTM we have to show nothing. In trading we have to show nothing. And in AFS we have to show unrealized income. So let's do a couple of examples on HTM, then we will go on to AFS and trading. Example number 1. You purchased a bond at time 0 at a price of 1000. Coupon rate of the bond is 10%. Face value of the bond is 1000 and maturity of the bond is 1 year. At what price will you show this bond on balance sheet? How much on income statement? And how much on OCI? Now at time 1, the market price of this bond happens to be 1017. The fair value of this bond at time 1 in the market is 1017. Tell me, it should be shown on balance sheet at what price? 1000. Because my cost and amortized cost in this example happens to be same, 1000. How much will we show here? 100, because I have received a coupon payment of 100. So this is my coupon payment. And what do we show in OCI? Nothing, which means we completely ignore the market price. Second example. Let us say you have purchased a zero coupon bond at time 0 for a price of 375. Face value of the bond is 1000 and maturity of the bond is 8 years. Now at what price this bond should be shown on your balance sheet at time 1 if the market price of this bond, market value of the bond at time 1 happens to be 392. At what price should we show this on balance sheet? I purchased it for 375. Face value was 1000, maturity was 8 years, market value is 392. It's HTM. Huh? 423. How many of you feel 375? Please raise your hands for 375. Okay. 392. Okay, so all of us are in agreement that this is to be ignored. Any other number? How much? 580? 582. 423. Yes, anyone else? Okay, so what we do in this case? Step number 1, find out what is the YTM of the bond. Second, clear TVM. Minus 375 present value. 1000 future value. 8 is N. Compute IY. 13.04%. Store this YTM with all its decimals in the first memory slot. Meaning of which is this is what we are earning every year. So what is the amortized cost now? Second, clear TVM. And there are multiple ways in which you can calculate. The difficult way of calculating it. 1000 future value. RCL1 IY. And now after 1 year remaining period is 7. So 7 is the N. Compute present value. 420.91. So this is one way in which you could have calculated this. Or second easier way, simply say 375 plus RCL1% equal to. That means 375 plus 13.04%. And that would again be 423.91. That means every year the value of bond will increase by 13.04%. Following this, so this is called amortized cost. How much will we have on income statement? Have we received anything? No, and therefore my realized gain is? Is my realized gain 0? I have earned interest, it has not been paid to me in cash. Realized gain does not mean received in cash. So I purchased a bond of 375. After 1 year, if company decides to pay back, minimum that it needs to pay back is 423. So my realized gain, though not received in cash, is the difference of these two. 348.9. So this is my realized gain, and in OCI we do not put anything. Is that clear? Example 3. Yes, so that was the case in the earlier case also. When you are in held to maturity category, market prices are irrelevant. You can completely ignore them. Example 3. You purchased a bond at a price of 895. So value at time 0, 895. Maturity of the bond is 7 years. Face value of the bond is 1000. Coupon rate 10%. Market value of the bond at time 1 is 927. At what price will we show on balance sheet at time 1, income statement at time 1 and OCI at time 1 if this is classified again as HTM, held to maturity? Balance sheet, income statement and other comprehensive income. How much? 905. One of the answer I have received is 905. How much on income statement? 10 or 110? 110. And OCI? Let's start again. This is where we have to show amortized cost, realized gain, and nothing comes here. Second clear TVM, minus 895 present value, 1000 future value, 100 is your payment, 7 is your N, compute IY. How much is your IY? 12.32%. So you are earning 12.32% on this bond. Now, what would be the value of the bond at the end of year 1? That means remaining periods are 6. Second clear TVM, 1000 future value, 100 payment, 12.32 IY, 6 is N. 6 is N, compute present value, that would be 905. So every year in this fashion bond price will increase in such a way that 895 will become 1000. So this distance of 895 to 905, this is my realized income though not received in cash, which is of 10. Plus I would receive coupon of 100. So my total income 110 and nothing goes to OCI. Are we good to move? Let's do examples now for available for sale and trading together. You purchased one share for a price of 100 at time 0. At time 1, the market price of the share is 127. And during the year, you also received a dividend of 10. So what is the amount at which we should show this on the balance sheet? If it is classified as AFS or it is classified as trading. Yes, in AFS at what price? And trading? 127. So both of them are at fair value. What will we show on income statement in AFS? Only the realized income. Here and on income statement 37, realized plus unrealized both. What will we show in OCI here? Unrealized income. And what goes to OCI here? 0. Now how does your balance sheet tally? So let's make a balance sheet and income statement here. So I'll just make it somewhere here. Let's say this is balance sheet and this is your income statement. Now originally you had a share of 100 and 100. So let me say that my equity is 100 and my investment in financial instruments, so I'm simply saying shares of 100. Now by the end of the year they became 27. So you will make the shares on balance sheet as 127. Immediately a compensating entry in your reserves, which is your OCI, you will make 27. So second effect tallied. Then you will receive dividend of 10. So you will have a cash of 10. This cash of 10 will go to income statement here. Then your net profit would be 10, which would again eventually be transferred to reserves. So you will have 10 here. So on both the sides we have increased by 37 and balance sheet tallies. Followed? Originally it was 100 and 100. 100 equity shares and investment in shares 100. Market price became 127. So you made this as 127. That means the asset side you have increased by 27. You will give a compensating effect by increasing OCI of 27. So added 27 on the asset, 27 on the liability. Then you receive dividend of 10, which you will show as cash on the asset side. Second effect of that goes to the income statement of 10, which results into profit of 10, which again effectively comes on the balance sheet liability side to retained earnings 10, and then the balance sheet tallies. Is that okay? No, what would be it called? Investment into, huh? Investment in financial instruments, then 3 categories: HTM, AFS and trading, and then this would be called as AFS. What happens here? This is your balance sheet. Originally you have equity share capital of 100. You have investment in financial instruments 100. You have received a dividend of 10 and your shares have now become 127. So on the asset side you've increased 37. What you'll do is on your income statement you will show income of 37, which is made of two parts, 10 and 27. And the second effect, again the interest income would be transferred to reserves. So this would be 37. Again balance sheet will tally. Is it done? Any questions? Let's bounce off then. Okay. So we know HTM, we know trade securities designated at fair value. In AFS, is there any difference in IFRS and US Gaap? Yes, so he remembers exactly. This is a difference, so you can make a quick note of this. You'd come across plenty of flowcharts, so keep your hands running fast. The differences in the treatment of unrealized gains or losses resulting from foreign exchange movement. In IFRS, we put them in income statement. In US Gaap, we put them in OCI, which is in equity. Done. Now understand, nothing new is happening in US Gaap per se. That the gains are recognized in equity. Any unrealized income from whatever source in AFS goes to equity. But in IFRS, we will divide unrealized income into two parts. Let us say you bought an asset for rupees 100 into a foreign currency. Okay, so you convert it to US dollar and let's say it was 2. After some time, that asset itself became 2.2, or let's say in rupee terms it became 130. Now this gain of 130 we can divide into two parts. So we can say that about 10 rupees is coming from foreign exchange movements and about 20 rupees is coming from appreciation in the value of asset. If I'm in US Gaap, the whole of the 30 would be transferred to OCI because it's unrealized income. If I'm in IFRS, I will say the first 20, which is unrealized gain on the asset, that would go to OCI. But the 10, which is coming on account of foreign exchange movement, that would be transferred directly to income statement. Okay, so IFRS gives you a differential treatment. This is what you need to remember. Should we move on? Okay, enjoy this part now. Here we are discussing whether is it okay to transfer assets from HTM to AFS or AFS to trading or trading to HTM, so on and so forth. So these are your 4 categories. As far as accounting treatment is concerned, trading and designated fair value are almost treated same, but they are given slightly different treatment when it comes to reclassification. So prohibits anything into or out of this category, which means this section is kind of isolated. HTM to AFS is okay, AFS to HTM is okay. So first you can observe this and then probably you can write down. At what rates do we make the classification from one to another? If you are going from HTM to AFS, that means held to maturity to AFS, you will make the transfer at fair value. That means the category in which we are transferring, we are using that rules. So if I am going into AFS, then at fair value and unrealized profits would be shifted to OCI. So again, easy to remember. If I am AFS to HTM, the other way around, now ideally at what price should it come in HTM? Amortized cost, but it will not. So here at fair value. Okay, so which means if reclassification ever happens from here to here or here to here, the price at which it is happening is at fair value. In case of AFS, the profit went to OCI. In HTM, previous profit in OCI is amortized to P&L. Okay, so this was your first set of classification. Now you can write this section so that we'll go on to subsequent ones. So I really doubt whether there would be questions on reclassification on the exams because it's too much memory based, but on the safer side we'll try to memorize them. Are you done writing this? So let's try to recall. HTM to AFS is okay, AFS to HTM is okay. The classification on balance sheet is happening at fair value. On income statement, the treatment would be given based on in what category I have reclassified. So I have reclassified that into AFS. So any unrealized gain that I will have, that would be transferred to OCI. So this was easier to remember. If it's vice versa now, I'm going from AFS to HTM, again transfer happens at fair value. But a lot of unrealized gain would anyways be as of now accumulated in OCI. Let's say remaining life of asset is 3 years. Then whatever is the unrealized gain, that I will amortize to HTM over the period of 3 years. That means unrealized gain would be amortized into income statement over the period of remaining life of the assets. Is it okay? Next ones now. Reclassification in US Gaap. Again, it is allowed for all categories into all categories, and all the reclassifications will be happening at fair value. Now, HTM to AFS or trading or fair value, all the 3 are allowed. But if you do that, then it would have some sort of implication for use of HTM for future purpose. Okay, which means you are allowed to do that in very rare circumstances based on very stringent set of rules. But then if you do that in future, you might not be allowed to use HTM easily. Okay, this is the implication. we can, but again same implication of use of those categories, which means generally it will not be done. That's why it's not being mentioned. Yes, is it done? I mean, at what price we will transfer? All transfer would be done at fair value, and profits would be depending on what category we are transferring. So AFS, same logic what we use in IFRS. Now, HTM to AFS, again same intuition. Unrealized gain would be transferred to OCI. AFS to HTM, accumulated amount in OCI would be amortized. HTM and AFS to trading, transfer again at fair value, and unrealized gain will go to income statement.
So when we are transferring from AFS to trading, in that case, if the asset was in AFS category, so previous unrealized gain would have gone to OCI. So would we not start amortizing those now?
To trading?
So once we have transferred to OCI, the amount that is in
You're
OCI
transferring from where to where?
AFS to trading.
Huh.
So
So whatever is in OCI, shift that to trading in one go. Whatever is in OCI, take that amount, put that into your profit and loss account, income statement. Yes, is it done? Any questions you want to ask here? Okay, so I don't think there is much complications here. What we need to remember is that a transfer will always happen at fair value. The treatment of income statement would depend based on in what category I have reclassified. So if HTM was reclassified to AFS, then what will we do on income statement? Sorry, what will we do with unrealized gain? The whole of the gain would be transferred to OCI. If HTM goes to trading, the whole of unrealized gain would be in income statement. If AFS goes to trading, then the whole of unrealized gain would be transferred to income statement from your OCI. Okay. Now we have come on to the impairment of these assets. Now if you remember at level 1 we had impairment for fixed assets. Okay, though there was some reference mention that even the investments are tested for impairment. So this is where we see that what happens if there is an impairment and we are in held to maturity category. The carrying value would decrease and the loss would simply be transferred to income statement, which means you have a held to maturity, let's say of 100 on balance sheet. After doing impairment testing, you realize that value is 80. So the difference of 2 would be simply shown as a loss on the income statement. I think you can write down first. No, slightly different. 80 rupees on the balance sheet. We'll do examples for all three. Have you written this? Let's try to understand what this is saying now. Let's say you have held to maturity on your balance sheet at this stage for a price of 100. You decide to test this for impairment, and after testing for impairment you realize that this asset is worth 80. So on balance sheet now onwards you will start showing it at 80, and then 20 worth of loss would be directly realized onto the income statement. So straightforward treatment. AFS and trading is interesting, the reason being that on balance sheet they are anyways at fair value. So if the market price is reduced, automatically the reduced balance sheet value is there on, reduced value is on balance sheet. So let's say that the carrying value of your asset is 80 today. Okay, even the market value is 80, so you don't have to really worry about anything on balance sheet. But in your OCI, you must have charged an unrealized loss of 20. When you decide that there is a significant impairment, which means that loss is other than temporary, that 20 loss is not a temporary fluctuation, it's a permanent loss, then you will take this loss from OCI and transfer this to income statement. Okay, so that's the only difference. Otherwise on balance sheet the value will remain as it is, but the loss which is in OCI, that would be taken out and charged to your income statement. And in trading we don't have to really impair because it's anyways at market value. All the gains and losses are on income statement. It would have higher losses. So you're being conservative. You know, the intuition behind putting unrealized losses in OCI, your intuition is these are unrealized losses because of fluctuation in prices, so it will reverse soon. But if that loss happens to be significant loss and a permanent loss, then you want to book those losses into income statement, so you would bring it back to income statement then. Okay. Now one more flowchart on impairment, which is here. First I'll explain, then you can write. Both US GAAP and IFRS require annual testing of impairment for AFS and HTM. Okay, now again this we need to remember because in certain cases it's not annual. Okay, so we'll see that later on. But in case of investments, both US GAAP, IFRS require annual testing. In US GAAP, you are required to impair if the decline is other than temporary, which means permanent in a way. In IFRS, you will impair in following two scenarios. In debt security, impair if at least one loss event has occurred. Okay, so in original IFRS documents, they have given different examples of loss events. For example, let's say you have defaulted on payment of interest, or you have defaulted on certain other covenant that was there in your bond agreement, indenture. So if you've done that, then this is one of the lost event, and then you would be required to impair. In equity security, you will impair if fair value in the market has reduced substantially. So in this context, I just want you to remember one important point, that downgrade in credit rating is not considered as a loss event. Okay, if you remember this much, this is more than sufficient for this particular section. That if there is a credit rating downgrade, that does not necessarily mean this is a loss event. That's it. And then you can make this flowchart now. Are you done writing this? I think the overall decrease in market, if that's considered as a permanent decrease, then we'll have to book the impairment losses. But the overall decrease in market is because of some sentiments, which is not a permanent decrease, then we would not really recognize this. So see here, this is something that management needs to decide. Okay, because IFRS is not a code-based standard. It's more of, they will give you certain scenarios as examples, but you would have to decide as a manager. So if that decrease is something going wrong in that company, price decreasing, you would impair. Something going wrong in markets and you feel that that's a permanent, it's a prolonged period, then you would recognize. But if it's a temporary, you would ignore.
So in case of debt securities, let's say when the credit rating goes from B to junk, so you are not going to test for impairment because of the downgrade of the ratings, but because of the value of those bonds being reduced.
Yes, if it's a permanent, correct. So basically that downgrade in rating has not really been defined as a loss event.
But anyways, if the rating gets downgraded,
The bond value decreases. What if there is an increase in stock price? In IFRS, again, if you're convinced that it's not a temporary fluctuation, then you're allowed to reverse it. So impairment is allowed to be reversed in IFRS, but in US GAAP, once downgraded, always downgraded. So US GAAP never allows you to reverse. IFRS will allow you to reverse. Okay, again, there is a flowchart for this. We'll see later on. Are we done up to this? Okay, so now let's take a small break.